Welcome back, everybody, to Keys and Gears. Here we are, Bess, Dickson, Mark Liesner, local lender, local real estate agent here in Texas and Dallas, Texas. Welcome, everybody. We're going to talk today about hot topics we heard this week. This is my turn, actually, hot topics for the week in financing. So did you hear anything about financing on your end, on the real estate side? Any questions that we should talk about, or should I dive into what I heard this week?
Oh, very generous question. My big thing is it seems like there's more and more self-employed people. And they're like, I've got this money in the bank. I was just talking to Yahoo, not Mark, Linder.
Right. Thank you.
And I'm never going to be able to buy a house. And that's their frustration.
So two things to unpack there. One is affordability and one is income, right? As these home prices increase more and more, we see less and less people being able to afford homes, at least in the immediate neighborhoods of Dallas and Houston and Austin and places like that. The other part is, how do you justify your income? How does a lender look at your income? Let's do the income part, self-employed income. It can be tricky because a lot of self-employed people love to write off everything.
Well, because your life is, in fact, your business. So.
Exactly, and saving money on taxes is always a wise choice. But there's a fine line. If you're preparing to purchase a home in the near future, you probably will have to adjust your tax returns if you're self-employed.
And near future being defined as 2 years?
As you know, if you've been in business longer than 5 years, you probably can get away with 1 year tax return. If it's less than that, they're going to average out 2 years. The underwriter is what I'm talking about. So the lender's underwriter will look at your income consistency over time. And if you have a track record, they look at less consistency is okay. So 1 year tax return is okay. But if your business isn't in existence that long, then they're going to look at 2 years and average the two out. So I have consistently seen self-employed people, make $200,000, but they show $30,000 on their income tax, right, as income. And so that hurts you, obviously, because you can't buy much of anything with $30,000 income. So at that point, you may want to add a family member to the loan.
Like a co-signer.
A co-signer to the loan of some sort. I've seen that done pretty well. You can also go with a self-employment loan. They're not called self-employment loans, but technically they are, which is a bank statement loan, for example, is an example of that, where they take your cash flow coming in and out of your bank statements as income, and they average that out. But they also discount that income. So they discount that cash flow, I should say, not income. So that way the underwriter can see, okay, you've decreased your tax liability, and that's why you're only showing $30,000 of income, but you have all this money coming in that you're using. So that makes it more manageable for the underwriter to okay the loan. The downside to that is, obviously, the higher the risk, the higher the rate. Okay, so if your credit score is not high enough, if you don't have enough assets, and if your income isn't that great, then you're a high risk person. So therefore your rate's going to be sky high. So I've seen, depending on these three factors, income, credit score, and assets, I've seen rates as high as 10%, right?
Wow.
For self-employed people, for bank statement loans. And I've seen it as low as 7.5%, right? So not much higher than a regular rate. So, and then there's a way to do this where you maybe bridge the gap, where you do a self-employment loan for the time being and pay a higher interest rate.
Interesting.
But then a year or two down the road, you've righted the ship, so to speak, with your tax returns.
And refinance
at that point
Nice.
into a lower rate.
Nice.
And so there's ways to bridge those gaps, that you have, or those challenges in qualifying.
And I'm hearing, to put it in us layman's terms, what you were just saying, I'm almost hearing that it's not too dissimilar, I believe, if I heard you right, from if anyone's ever gone to a horse track and bet on horses, the rate of return on your bet
Yes.
is higher, the more risky or the less
Likely to win.
to win.
You make more money.
Right.
It's more risk, so therefore you need
So
a bigger reward.
it's a long stretch, I guess.
Right.
Since
No,
a
no,
group with a horse,
it
here's my
is.
brain going to horses.
It is.
But
It is. It is.
but I mean, lenders are businesses after all.
They are. They don't do
and
it
so
for charity.
It makes sense that the interest rate is commensurate with your
And
risk,
That's why interest rates are
file risk.
rarely the same from one buyer to the next. You can't just quote if I give you an interest rate without looking at your specific financial picture, it's a generic rate, and I could quote you 6% right now.
I'll take it.
doesn't-
Okay, sign me up.
It doesn't mean anything because it's not a real rate.
Right.
So when you call up a lender and say, "Hey, what's the rate this week?" They're gonna say to you, "Without your application, I can't give you a rate." So I can give
Or
you,
they should say that.
Right. I mean, you can give a generic rate and say, well, generally speaking, if your credit's good, if your income's good, if you have good assets, the rate should be around this number. But it's very challenging for us in my field to give you a quote without an actual
Interesting. So
application.
that's almost a good way for the consumer to do an integrity check.
Right.
A quick
Well,
integrity
yeah.
check on their possible lender partner
Especially online rates.
is if someone just promises you the world from the get-go.
Right.
I'm hearing danger.
Be careful. There's fees and rates are like a balloon that you squeeze. So the higher the fees, the lower the rate. A lot of times, the lower the lower the fees, the higher the rate. So but it's a balancing between the two, and some of these lenders are playing shell games where it sounds good, but it really isn't because you're financially shooting yourself in the foot because you're focused on one ball that's up in the air instead of the distraction that they've thrown up in the air, and they're doing something over here that's costing you more money than if you leveled out everything. So again, that's why you need somebody like me who's a broker who can look at these different lenders and say, okay, this lender, the fees are low, the rate's a little bit higher. This lender, the fees are higher, the rate's lower. Which one do you want? I can only show you these two, and how does that affect you financially over time?
Over time.
Then it becomes a question of how long are you going to own this? What's your plan? How does that fit into your overall financial planning picture, et cetera, et cetera? And so then you can make a smart choice between the two. So that's one thing I heard. This week I heard mostly about why are rates not coming down, what's going on.
Why aren't they coming down, Mark?
And we've talked about this in previous episodes. It's not a one thing that makes rates move. It's the whole picture. It's not only a rates are local, right? So first of all, a Texas rate.
Rates are local.
A Texas rate is different than a Connecticut rate or a California rate. So the interest rate varies by locality. So you have that factor. Then there's a national, the local economy affects the rate. The national economy affects the rate. The global economy affects the rate. So all those things together. So it's not that you can say, oh, the 10-year bond rate went in the right direction. Now we're going to see rates come down. And that's what the media focuses on. That's what they talk about. But it really isn't the end-all, be-all for rates. Just like when the Fed lowered the rate, the actual mortgage rate didn't go down. It went up.
It actually went up.
Yeah.
And I was 911 you. Like, what the heck, Mark?
Yeah. Oh, you and everybody else. I had people waiting for their rate. They were convinced the rate was going to drop. I told them all along, I don't see a reason why rates are dropping this year or next year. We're going to fluctuate between that 6% and 8% range. It's a big range, and it's going to be volatile. It's going to be up and down. I mean, from August of 2024 to today, we've gone 1 percentage point. We've gone from 6.125 to 7.125 in that 5 months. That's been 5 months as of this filming that, we've gone a percentage point up and down. We've varied.
Real quick, percentage point, put that into real live touchy-feely dollar numbers to a house. What does that mean? if there's a percentage point difference equals 500 square foot difference in your house for the same price for
I
this.
can't do it off the top of my head. You kind of that's
sorry,
yeah.
But, I mean, or does it? I mean, you know what I'm saying, or does it just mean an extra $100 a month,
it makes a big difference. So on a $300,000 loan, if you're talking 1%, you're probably talking in the neighborhood of $200 a month difference around that number.
Interesting.
So
200 times 12, $2,400.
Yeah,
it makes a difference.
It's
a vacation.
It makes a big difference, and so rates shouldn't be coming down anytime soon. They're going to fluctuate, but we're not going to see really low rates. I don't think there's no reason to, because historically these are normal rates. This is a normal rate. 6-7% is actually a very good rate historically. So. So I caution people, again, I've said this before in other podcasts, forgive me for repeating myself, keep your eye on the right ball. The ball is, do you need a home? Do you want a home? Do you want a different neighborhood? Those are the things you need to worry about, not the rate, okay? The rate is going to be the rate.
The rate's going to be the rate.
And your cash flow every month, meaning money coming into the account, money coming out of the account, that's what we need to look at, is affordability for you. It's not the rate. It's how affordable is this new house to your current budget, to your current cash flow. So I've done a lot of conversations like that where I've taken their focus off. Where's the rate going to? Hey, let's talk about your monthly payment. Let's talk about what that looks like now versus the next house, regardless of the rate. Because like you said, what difference does it make? 1%. How much difference a month does it make? I don't know. Can you tell me? And that's really,
we've got to sit and talk about it.
How does it fit? How does it fit?
How does it fit?
How does it fit into your budget?
Wow.
So,
and that's part of your process, is just taking the time to sit and hear their story.
Absolutely. And that's part of financial planning, right? You got to look at overall picture, where are your savings? How's your investment? How much money are you diverting to those things that are super important for your retirement? And how much of a factor do you want the house to be part of your retirement? And some people are very house focused, so they want to buy the biggest house possible and accumulate retirement savings that way because they're going to sell it eventually. Or they're super focused on 401ks and savings and grow their nest egg that way, or they do a combination of the two.
Very nice.
So that's kind of what I heard this week. More exciting than that is our weekly picture of the week.
Our picture of the week.
Our weekly
wow
that Bess
our
saw.
Weekly like, oh my gosh.
Oh my gosh, what are we looking at this week?
The picture that we're looking at right now is a picture of a home that is in fine condition, and we are taping this during the time of property tax, when we get a lot of calls about how do I mitigate my property tax. This family, it's a great example. They have never pulled out their bushes, their holly bushes that are mostly dead, not completely dead, from Ice Mageddon that we had in Dallas in February of 21.
Wow.
And it is still painted a very slight, to most, I will say to most, but to this agent, slightly repulsive trim color of orange with orange brick.
I would agree with that.
Anyway, all that to say, they were fine with it because it's a rear entry garage house. Okay. So they never see it anyway.
The front.
Right? Yeah. And they were really enjoying, okay, and here's the point of this, Bess, the tax deal. And they were appreciating the fact their taxes were not going up as much every year as all their neighbors that were busy fluffing in the front. Right. They were busy fluffing in the front. All that to say, we're getting ready, can't confirm nor deny, might be listing in the near future. So now we're talking about
different.
Right, because it's also past January 1st, so technically the appraiser has already done his drive-by and decided once again this house is only worth this amount, so we're only going to tax at this rate. And but when you're getting ready to sell, so there's real estate value and there's tax value.
Right.
So this is the tax value.
Yes,
picture.
that's the tax value look. The
look.
real estate look needs to be.
It's going to be a little bit different.
Needs to be the runway
so stay
model.
tuned. There you go. So those of you all listening,
we're gonna see progression
possibly
next
those of you
time?
listening to us and not visualizing on YouTube
Love
or
it.
whatever. Yeah, it's just basically it's a Chicago style
Yes,
type
that
brick.
brick.
Chicago style meaning that it is a brick that it looks like old paint on it.
Yeah.
It's got black and cream on an orange brick, and then it has orange trim. So it just screams orange. And then we have these lovely, mostly dead, not completely dead bushes.
And blue gutters. Okay. Yeah, there's all kinds of things going on.
All kinds of things going on.
Yeah, well, you're going to do a best number on this, so we'll be excited to see the future picture.
There you go.
Hopefully.
All right.
That'd be great.
Well, speaking of seeing, hope to see you next time.
Yes, please tune in next time.
On Keys and Gears
Subscribe and
with
like.
Mark and me. Yeah.
Thanks for your time.
Absolutely.